Okay, let's jump right in. So picture this.
Right.
You check your bank's website, one of the big ones, right?
Yep.
And you see the interest rate on a 1-year fixed deposit. Well, it slipped below 1% for the first time ever.
Mm-hmm.
And just for keeping your money in a regular deposit account, we're talking basically zero, like 0.05%.
Yeah, practically nothing.
Now, look, that might just seem like a small number changing on a screen, a minor detail.
Sure.
But interest rates, they're kind of like the absolute core thermometer of the economy, aren't they?
That's a great way to put it, yeah.
And when that thermometer is sitting near zero, it's practically screaming that something pretty profound is going on underneath.
It really is. And what's fascinating, I think, is how that tiny shift in a bank rate, it's really just a symptom of these much bigger interconnected forces playing out.
Right.
This whole environment of really low, near zero interest rates.
Wow.
Well, it doesn't feel like just a temporary blip anymore. It feels more like a fundamental shift, one that's really reshaping economic and even social dynamics.
Absolutely. So our mission here in this deep dive is really to understand the signal behind that number. Why are rates falling so low? What are the really deep reasons driving this?
Mm-hmm.
And maybe more importantly, what does it actually mean for your money, your personal finances, and maybe even for society as a whole? And, crucially, how do we actually navigate this new low-interest world, practically speaking?
Well, to get at the why behind these near zero rates, we kind of have to step back to a really basic economic principle.
Okay.
Interest rates. They're basically the price of capital, right? The cost of borrowing money.
The price of money, yeah.
Exactly. And like with anything else, when the price is super low, it usually points to one thing. There's a huge supply, but maybe not so much demand, oversupply, essentially.
So you're saying capital itself, money looking for a place to go to be used, there's just too much of it floating around compared to the opportunities to actually use it productively.
Precisely. Capital is abundant, maybe even overproductive in a sense. But there's this significant lack of demand from businesses, from individuals, to borrow that money and put it to work.
Okay.
And we can see this really clearly in two big market trends happening at the same time.
What are those?
So on one hand, you've got this explosion in deposit scales. People are just saving like never before. Residential deposits, they've surged to, get this, 160 trillion yuan.
Wow, 160 trillion. That's a staggering number.
It really is hard to wrap your head around. If you average it out, it's something like 105,000 yuan for every single person in the country.
Wow.
And here's the kicker. That amount has doubled in just the last 6 years.
Doubled in 6 years?
Yeah.
Oh.
I mean, think about it. It took something like 6 decades to build up the first half of that pile, and then just 6 years to add the second half. It clearly shows people are holding on to cash, parking it in banks.
So the banks are literally flooded with deposits. But you said the other side is weak demand for borrowing? Where's that weakness coming from?
Right. That's the flip side of the coin. Decreased financing demand.
Right.
Businesses, in a lot of sectors, they're bumping up against overcapacity issues. They just don't see enough profitable opportunities out there to justify taking out big loans for expansion or new projects.
Makes sense.
And at the same time, individuals, households, they're borrowing less too. Part of that is definitely the slowdown in the real estate market, which, historically drove a massive amount of lending.
Sure, mortgages were huge.
Exactly. And now we're even seeing people actively choosing to pay off their existing mortgages early, so that further cuts down household debt and the need for new borrowing.
Okay, so banks have this massive wave of deposits washing in, but the usual customers, businesses looking to expand, people buying homes, they're just not lining up for loans like they used to.
Yeah.
That puts the banks in a really tough spot, right? How do they react?
Well, they react the way any business does. When supply and demand are out of whack, they adjust their pricing.
Mm-hmm.
And for a bank, their key price on the deposit side is the interest rate they offer you. So they look at the weak loan demand. They probably anticipate that the rates they can charge for loans will fall even further in the future. And so they start lowering the rates they pay on deposits now, especially the longer-term ones. Why would they promise to pay you, say, 2% for 5 years if they think they'll only be lending that money out at 1% or less down the road? They've got to manage that future cost, that risk.
That makes perfect sense from their perspective. It's just business logic. And is that why we sometimes see those really weird situations, those inversions you hear about?
Exactly. We've seen some pretty, extreme inversions, as you call them, where maybe a 1-year deposit rate is actually higher than a 5-year rate. And not just at tiny rural banks. We saw this even at some major commercial banks earlier this year.
Which feels totally backward intuitively.
It does.
Yeah.
But it's a clear signal from the bank's point of view. It tells you they expect rates to keep falling, and it tells you they'd much rather have shorter-term funds, funds that give them more flexibility instead of locking themselves into paying higher rates on long-term deposits when they don't have enough borrowers lined up to make it worthwhile.
So you end up with all this money just piling up inside the financial system. It's stuck in deposits. It's not really flowing out into the wider economy through loans or investments. It's like having this enormous lake full of water, but the rivers that are supposed to carry that water out to irrigate the fields or power the mills, they're just drying up.
That's a really good analogy. Yeah. A massive amount of capital is just sitting there, idle. It's not becoming what economists sometimes call active
I
money.
said muddy.
Yeah, the kind that circulates,
Yeah.
from consumer spending to business revenue, then maybe business investment creating jobs, then wages get spent again.
Yeah.
That cycle. When that circulation slows right down, the whole economy just feels sluggish, kind of stuck, even if the headline figures like the total money supply look really big.
And the central bank, they see the situation, right? They see loads of money exists, but it's just not moving. So what's their strategic play here?
Well, the goal sort of shifts, doesn't it? It's less about just pumping more money into the system.
Right, because it's already there.
Exactly. It becomes more about trying to get the existing money to actually move within the system, and the main tool they have for that is lowering interest rates.
How does that work?
The basic idea is to make just holding money in the bank so unattractive, with basically zero return, that people and businesses are subtly nudged, maybe even forced, to look for alternatives.
Like spending it or investing it?
Precisely. To spend it on goods and services or to invest it in anything that might offer a better return than zero. It's really an attempt to kickstart that active money flow again.
Okay, that makes sense for explaining the immediate situation, this sort of capital supply and demand imbalance.
Yeah.
But you mentioned earlier, this isn't just a temporary thing. It's being driven by these deeper, more systemic forces that might make this low-interest era almost, well, unavoidable for the long haul. What are those big currents pushing us this way?
Yeah, this is where it gets really structural. There are, I'd say, maybe 4 major long-term forces that are kind of converging and really accelerating this trend towards lower, maybe even zero interest rates.
4 big ones.
The first one, and maybe the most fundamental, is just demographics, the aging population.
The gray tsunami, as some people call it.
Exactly. It's a demographic reality, and it has really profound economic consequences. If you look globally, there's a pretty clear link. Countries with higher proportions of older people tend to have lower central bank interest rates.
Like Japan.
Japan is the classic example, yeah. Back in the early 1990s, their aging rate was roughly where China's is heading now. And over the next 30 years, as their aging population ratio climbed towards 30%, their interest rates just steadily marched down towards zero.
And the connection is basically about who's saving versus who's borrowing. Is that the core of it?
That's a huge part of it, yes. An older population generally means you have a larger share of people who are net savers. They're building up nest eggs for retirement or maybe living off the savings they already have.
Right, they're past their peak spending years.
And they also tend to be more conservative investors, often preferring the perceived safety of bank deposits, even with low returns. On the flip side, you have relatively fewer younger and middle-aged people. And they're usually the main drivers of borrowing, taking out mortgages for homes, loans to start businesses, financing big purchases.
So less borrowing demand built into the system.
Exactly. This whole demographic shift just structurally reduces the overall demand for capital in the economy. And when demand falls, the interest rate naturally gets pushed down. It also changes the whole dynamic for industries like real estate, and it shifts the main engines of economic growth away from, say, housing construction.
Okay, so aging populations mean more saving, less borrowing, structurally. That's force number 1. What's the second major force?
The second one is this really widespread trend of deleveraging happening across the economy. Basically, most players, households, businesses, even local governments, they're hitting, or maybe have already hit, pretty significant limits on how much debt they can comfortably handle or are even willing to take on.
So it's not just that they don't want to borrow as much, it's that they kind of can't or shouldn't borrow much more because they're already stretched.
To a large extent, yes. I mean, look at residential mortgages. The amount being added each year is way down compared to the peak years. Businesses, like we said, are often constrained by market saturation or overcapacity, which makes borrowing big sums for expansion seem less attractive, maybe even risky.
So who can borrow more?
Well, right now, it really only seems to be the central government that has significant headroom to increase its leverage. And that's why we're seeing this noticeable uptick in national bond issuance.
So is the future picture one where the central government sort of takes on more debt to keep things going while everyone else, households, companies, local governments, tries to slowly pay down their debts?
That looks like the emerging model, yeah.
Yeah.
You could call it central government actively leveraging up, using its balance sheet to support the economy, combined with local governments, households, businesses maybe passively deleveraging. This process inherently involves a kind of transfer of risk, but it also structurally dampens the overall demand for borrowing in the wider economy. And that particularly weighs on longer-term interest rates, like the yield on the 10-year government bond. Many analysts think that could drift down further, maybe towards 1% or even eventually zero.
Okay, so we've got aging and deleveraging, two powerful forces. What's the third one?
The third one is maybe a bit more abstract, but it's crucial. It's a systemic decline in the overall return on capital across society. Falling interest rates aren't just a policy choice by the central bank, they're also reflecting this underlying economic reality.
What do you mean by return on capital, like profitability?
Yeah, essentially. Imagine you're thinking about building a factory or starting a new business line. If, say, 10 years ago, you could reasonably expect to make a 10% profit margin on that investment, then borrowing money at 5% interest. That's a no-brainer. You borrow, you invest, you make a good profit.
Yeah.
But what if today, because of intense competition, maybe global oversupply or changing markets, your expected profit margin on that same investment is squeezed down to only 2%?
Then borrowing at 5% or even 3% suddenly looks pretty unappealing.
Exactly. Borrowing at any significant interest rate becomes risky or just not worthwhile. So businesses aren't borrowing, not just because they're trying to deleverage, but because the fundamental profitability of putting new capital to work in traditional ways has decreased.
So interest rates are being kind of passively lowered by the economy itself, not just actively cut by the central bank.
In a way, yes. The real economy just isn't generating the kind of high returns that would justify paying high interest rates on borrowed money. And this fundamental decline in capital returns, it signals that the old growth model, just expanding production, relying on cheap inputs, isn't working as well. The economy really needs to find new engines, maybe driven more by domestic consumption or genuine innovation, to start generating higher returns again. Until that big transition happens, low rates are likely to stick around.
Okay, that's a big one. Aging, deleveraging, declining returns. What's the fourth force you mentioned?
The fourth force is this growing divergence, this gap between the returns you get from owning assets versus the returns you get from labor.
Asset returns versus wages.
Yeah. In a low interest rate environment, when central banks ease policy, a lot of that money tends to flow into the financial system. But it doesn't always spread evenly into the real economy, into wages and job creation. A significant chunk often finds its way into assets, things like real estate and prime locations or certain parts of the stock market, and that pushes their prices up.
So asset inflation, we hear that term a lot.
Yes, but the crucial point here is divergence. The speed at which asset values appreciate can often significantly outpace the growth in average wages or salaries. So if you already own substantial assets property, stocks, your wealth might grow quite rapidly in this environment. But if you primarily rely on your paycheck, your income from labor, your wealth might grow much, much more slowly or even stagnate in real terms. This widens the wealth gap. The paths of asset owners and wage earners start to diverge pretty sharply.
Okay, so these four powerful long-term drivers, aging demographics, widespread deleveraging, falling returns on traditional capital, and this widening gap between asset and labor returns, they're all pushing us towards this low, maybe even zero interest rate world. That's a massive shift. What does this actually do to how we think about wealth or even the fundamental structure of society?
Well, it fundamentally restructures both, I think, our wealth logic and our social logic. Let's start with wealth. A zero or near zero interest rate world basically signals that the old ways of building wealth relying on debt-fueled expansion or just parking money in the bank for a guaranteed high return, those are weakening, maybe even ending.
The easy money days are over.
In that sense, yes. The focus shifts really decisively towards what policymakers are calling high-quality development, which in practical terms means capital needs to be used with much greater efficiency and much more precision. You can't just throw money at things anymore and expect a good return.
So where does capital become efficient in this new world? Where's the smart money likely to flow?
Well, it seems likely to concentrate in a few key areas. Firstly, you'd look at technology breakthrough sectors, the strategic emerging industries, future industries, the stuff that's actually creating new demand or solving fundamental problems, boosting productivity.
Right, the high-tech stuff.
Yeah. And secondly, you might see it flow into areas that provide really stable cash flow, things almost like public utilities, or perhaps high dividend stocks, assets that can hold their value and provide some income even when overall economic returns are low.
And policy is trying to nudge money in these directions.
Absolutely. You hear a lot about directing funds towards these new quality productive forces. That's the direct policy response to this need for more efficient, more targeted capital deployment. But, this transition isn't painless. As capital shifts, traditional industries that are maybe less efficient or face declining demand, they struggle. And that creates real challenges around employment.
Yeah, that makes sense. So that's the wealth logic shifting. How does it reshape the social logic, how we live, our expectations, our daily struggles?
Well, think about that divergence we mentioned, asset prices potentially rising much faster than wages. When that happens, people can feel squeezed from two directions.
How so?
On one hand, their purchasing power might feel like it's being diluted. Even if inflation is low, if asset prices are booming and there's more money sloshing around, things can feel more expensive relative to wages. On the other hand, the traditional paths to building wealth, like relying on steady wage growth or assuming your house value will always go up significantly, those paths feel, well, less certain, more constrained.
This sounds like it could really feed into some of those social trends we hear about, like becoming a low desire society.
It's a potential outcome, yes. It can manifest in things like people cutting back on consumption, maybe delaying big life decisions like marriage or having children because they feel less economically secure, or they don't see those clear, reliable paths to upward mobility that maybe existed before.
And that, in turn, drags down consumer spending, domestic demand.
Which is a critical challenge for the economy, right? It really highlights why policymakers are increasingly talking about the need for things like strengthening the secondary distribution of wealth. How wealth gets redistributed through taxes, social safety nets, public
To
services.
cushion the blow and maybe boost demand from the bottom up.
Exactly. And also increasing investment in public goods like education and healthcare. These aren't just social goods, they're also investments in stability and can actually unlock new forms of demand that are rooted more in human well-being and capability rather than just material consumption.
Wow. Okay, this is clearly a massive economic and social transformation unfolding. It feels pretty unprecedented for many of us living through it right now. But does history offer any useful parallels? Have other countries gone through periods of really dramatic interest rate changes? Are there lessons, maybe cautionary tales we can draw?
Oh, absolutely. History is packed with lessons about the power and the dangers of messing with benchmark interest rates. They're incredibly potent tools for sure, but if you use them improperly, the consequences can be severe, often unintended. We've seen big mistakes made in both directions, hiking rates too much and cutting them too much.
Okay, let's start with hiking. Did China itself ever experience a period where rates were jacked up really aggressively?
Yes, definitely. Back in the mid-1990s, the economy had been growing incredibly fast, maybe too fast, and it led to serious overheating and really scary inflation. It peaked at something like 24% in 1994.
Yeah.
People were genuinely worried.
24% inflation. Wow. So what did the government do?
They slammed on the brakes using aggressive tightening measures. Interest rates were hiked very rapidly, very significantly.
How much did they go up?
While the benchmark lending rate between roughly 1993 and 1995, it jumped from around 8% all the way up to 13.5%.
Whoa! That's nearly double, a 70% increase in just a couple of years. What was the impact?
It caused a really sharp contraction. The banking system's leverage at the time kind of magnified the effect. Businesses just stopped borrowing overnight. Countless projects, especially in real estate, were just abandoned halfway through. You can still see some of those half-finished ghost buildings today in places like Hainan.
Any famous examples?
The story of Shi Yuzu and his incredibly ambitious giant building project is often cited. It collapsed during that credit crunch, leading to his bankruptcy. It became a sort of symbol of that whole period's fallout.
And the banks themselves, how did they fare?
They got hit very hard. As businesses went under, their loans went bad. Reports from the time suggested the non-performing loan ratios at the big four state banks soared, maybe even reaching 40% in some estimates. They were technically close to bankruptcy.
40% bad loans. That's terrifying.
It was. The economy really felt the shadow of that hard landing for years afterwards. It actually fueled a lot of the China collapse theory narratives that were popular internationally back then. So, yeah, it's a powerful lesson. Hiking rates too fast, too high can absolutely choke off credit and cause a severe economic drought.
Okay, so hiking too much is dangerous. What about the other way? Cutting rates too much? Does history have warnings there too?
Absolutely. That's where you get the classic stories of asset bubbles forming. Often these bubbles are linked to periods where central banks cut rates too aggressively, usually trying to stimulate a weak economy. The U.S. experience leading up to the 2008 subprime crisis is a prime example.
Right, 2008. How did rates play into that disaster?
Well, after the dot-com bust and the shock of 9/11, the U.S. Federal Reserve cut interest rates really dramatically. They brought their main policy rate down to effectively below zero in real terms by 2004.
Ultra low rates.
Exactly. And that super cheap money fueled a massive hunger for borrowing. Combine that with looser lending rules, especially in the mortgage market, with subprime loans becoming common.
Yeah.
And it just inflated this enormous real estate bubble. Prices went sky high. And when that bubble finally burst in 2007, 2008, it took the global financial system down with it. Many people point to those sustained, excessively low rates as a key ingredient that inflated the bubble in the first place.
And Japan's lost decades. Wasn't that also connected to rate cuts sometime
That
before?
it was, yes. Going back a bit further, after the Plaza Accord in 1985, the Japanese yen appreciated really strongly, which hurt their export-driven economy. So the Bank of Japan responded by slashing interest rates to try and boost domestic
How
growth.
much did they cut?
They cut aggressively. The benchmark rate was basically halved from 5% down to 2.5% in just about a year.
Another period of ultra low rates.
Right. And that flood of cheap money absolutely fueled a borrowing and investment binge, especially pouring into real estate and stocks. It created this astronomical bubble. You had stories about tiny plots of land in Tokyo's Ginza district costing fortunes, or the land under the Imperial Palace being theoretically worth more than all the land in California combined. Just insane valuations.
And then, inevitably,
Inevitably, it burst around 1990. And the fallout was immense, leading to decades of economic stagnation, deflation, the famous lost decades. So yes, both the U.S. and Japan examples serve as pretty stark warnings about the dangers of overdoing it with rate cuts. They can inflate these incredibly dangerous asset bubbles that cause immense pain and long-term damage when they pop.
it really drives home the point, doesn't it? Adjusting interest rates is powerful, maybe too powerful sometimes. It's like walking a tightrope. Miscalculate by just a little bit, go too fast or too far in either direction, and you risk either an economic drought or a catastrophic bubble.
That's exactly right. It's an incredibly delicate balancing act for policymakers.
Okay, so that historical perspective is really valuable. It shows the tough spot policymakers find themselves in. So for us as listeners, kind of facing this seemingly relentless trend towards very low rates, but now armed with this knowledge of the past risks, what can we actually do? What are some concrete steps we can take to navigate this new environment?
Well, we can certainly look at the experience of places that have been living with this for longer, like Japan during its zero interest rate era. But we always have to keep China's unique situation in mind, of course.
What did Japan's experience look like for ordinary people?
Well, observers often talk about a kind of three lows phenomenon setting in: low inflation, low consumption growth, and maybe even low desire or ambition, particularly among younger generations. The whole lying flat trend emerged there too.
You do.
Consumption patterns also shifted. People maybe moved away from splurging on traditional big ticket items like new cars or luxury brands, and perhaps shifted spending towards more comfort-oriented things or cultural experiences, anime, gaming, local travel, that sort of thing.
So maybe it points towards a broader shift, like the whole economy moving into a kind of low energy consumption mode as a result of lower overall returns.
That seems like a pretty plausible outcome, yeah.
Mm.
When the overall rate of return you can expect from investments or effort decreases, the whole system might just naturally settle into a slower, less frenetic pace. It's just a different kind of economic rhythm.
So how do individuals adapt to that rhythm? You mentioned strategies across different levels.
Yeah, I think it helps to break it down. Maybe think about strategies at the micro level, your personal finances, then the meso level industry trends and career choices, and finally the macro level understanding and maybe aligning with broader policy opportunities.
Okay, let's start micro. Our own money. What should we be thinking about?
Well, first and foremost, you probably need to rethink your asset allocation. Just leaving large sums of cash sitting in a basic savings account earning close to zero. That's not really going to preserve your purchasing power over time, even if inflation stays low.
So doing nothing is actually losing ground slowly.
Pretty much. So you need to think about diversifying, prudently, of course. Definitely keep enough precautionary savings aside for emergencies, probably best in major state banks for safety. But beyond that, consider allocating funds to other things. Maybe bonds, potentially a diversified basket of stocks through something like a broad index fund, like the CSI 300, always keeping your own risk tolerance front and center. Maybe even some physical assets like gold could play a role for some people. The key word is caution, though. Don't chase unrealistic returns.
Okay, diversify assets cautiously. What about our income? How we earn money?
Yeah, think about adjusting your income structure too. Relying solely on one job might feel a bit riskier in an economy that's deleveraging and going through big transitions. It might be smarter to aim for a
A
mix.
mix, like what?
Like having a stable core income from your main job, hopefully in a relatively essential or resilient sector. Think healthcare, education, maybe certain public services. But then also trying to build up some supplementary income. Can you monetize a skill you have, maybe through freelancing, short videos, and online side gig?
The gig economy idea.
Sort of, yeah. And then longer term, trying to build some passive income from those assets you're accumulating. The goal is to have multiple streams, making you less vulnerable to shifts in any one area.
Makes sense. And what about debt? How should we handle borrowing in this low-rate world?
Be really strategic about debt. Generally, you want to keep low interest debt only if it's genuinely productive, like maybe a very low rate mortgage on a home you live in, or perhaps carefully considered business debt. But definitely try to aggressively pay down any high interest debt you might have. Credit cards, personal loans, get rid of those first.
And existing loans.
If you have existing loans, like a mortgage from a few years ago when rates were higher, it's definitely worth exploring options for restructuring or refinancing with your bank. See if you can lock in some of these lower rates. Every bit helps.
Okay, good practical micro tips. What about the next level up mezzo? Thinking about industries and maybe career choices.
Right. Here, it's about trying to read the headwinds and tailwinds. Generally speaking, you probably want to be cautious about industries that are highly leveraged, struggling with overcapacity, like maybe some parts of traditional manufacturing or sectors clearly in structural decline, like perhaps domestic real estate development in many areas, or basic materials like steel.
So avoid the potentially shrinking sectors. Where are the potential growth areas, the tailwinds?
Look towards sectors that cater to new demands or benefit from structural shifts. Things like high-end services, maybe linked to consumption upgrades. Emerging sectors getting policy support, like the low-altitude economy drones, urban air mobility, that kind of thing. The silver economy, catering to the aging population, is obviously huge.
Technology.
Technology and innovation remain critical, absolutely. Industries benefiting from digitalization, green transition, advanced manufacturing, those have better prospects. While getting into high-tech R&D itself has high barriers, working in related fields or support functions could be smart.
And career development within those fields.
Yeah, try to position yourself in roles that add clear value. Think specialized skills, technology development, data analysis, specialized professional services, key business functions like strategic marketing or finance. Maybe try to avoid purely general administrative roles or routine production jobs, as those might unfortunately face higher risks of automation or layoffs as companies restructure for efficiency.
Okay, that's the industry and career angle. Finally, the macro level. How can we potentially benefit from, or at least align ourselves with, the big policy directions?
It's really about paying close attention to where the government is actively directing investment and support. Where are the fiscal dividends likely to appear?
Like what kind of areas?
Think about areas getting significant state backing. Digital infrastructure build-out, pushing industrial digitization, maybe urban renewal projects, major infrastructure focused on public welfare or environmental goals. These policy-favored areas often create significant knock-on opportunities for businesses and individuals involved.
So basically, follow the strategic money flow.
That's a good way to put it. And if you happen to be a business owner, the low cost of capital can be an opportunity. You could potentially leverage low-cost loans for genuine R&D, investing in technological upgrades, or maybe carefully expanding into new markets.
But with a big caveat, right?
Absolutely. The key is prudence. Strictly avoid excessive leverage, remember those historical lessons, and understand the broader context. Industries that are highly leveraged and inefficient are likely facing elimination or consolidation as the economy restructures. So if you're choosing where to work or invest, try to align yourself with enterprises that either have core technological advantages, unique market positions, or inherently stable cash flows. Those are likely to be much safer bets in this environment.
This deep dive has been incredibly enlightening. We started with that tiny dip in deposit rates, less than 1%, and it's unfolded into this picture of massive systemic forces reshaping basically everything how we think about money, investment, work, even society itself.
It really is a significant turning point, isn't it?
Mhm.
It reflects these profound underlying economic and social shifts that go way beyond just a simple financial tweak.
It absolutely does, and it really makes you step back and think, doesn't it? How does this fundamental shift, maybe towards what you called a low-energy consumption mode,
Hmm.
driven by these huge macro forces, how does that influence your own personal approach? Your attitude towards saving, towards spending, maybe even towards your long-term ambitions and aspirations? How might successfully navigating this new era require a fundamentally different mindset than perhaps the high-growth, high-return periods many of us grew up expecting? Definitely something worth mulling over as you think about charting your own course in the years ahead. We genuinely love to hear your thoughts on this. Jump into the comments section and let us know what resonated. Which type of wealth are you focusing on?
Yeah, let us know.
And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.